If the Fed cuts interest rates in 2024, will that automatically be good news for the market? That's the subject of this week's Fastest 4 Minutes in Finance. Hello, I'm Scott Inman. It's a new year, but we are still talking about the moves by the Federal Reserve. Now, the difference this year is instead of talking about how many times they might raise interest rates, now we're talking about a real likelihood that they will cut them. A few weeks ago, we talked about how rate cuts could affect the bond market. If you recall, bond prices are negatively impacted by rising rates and positively impacted by falling ones. So as such, fixed income as an asset class has a very good outlook if we stay on the current course. And just the possibility of rates being cut has been met with joy by equity investors in the last 2 months of 2023 as the major indices skyrocketed. But you might be surprised that historically, the market reaction to rate cuts actually happening is a little rocky. And it makes sense if you think about it. If the Fed cuts rates, it's because they worry monetary policy is too restrictive for a weakening economy. That would mean the economy is weakening. So it stands to reason that investors may be rejoicing that the Fed has finished raising interest rates, but they may quickly find something else to worry about with the overall economy. Take a look at this chart from LPL Research. It's a look at the past 9 rate hiking cycles dating back to 1970. In the far left-hand column, you see the dates of the final Fed rate hike, which experts believe we have already experienced this time around. In the next column, you see the dates of the first rate cut. In the next column, you see the return of the S&P 500 index between the final hike and final cut, followed by the next columns, which are the returns 6 months after the first cut, followed by 1 year from the rate cut, and finally the number of days between the last hike and first cut. You can see the returns are all over the map. At the bottom of the chart, you see the averages. The S&P 500 is up on average 4.6% between the final hike and first cut. Only 2.1% 6 months after the first cut, and 5.6% 12 months after the first cut. The index has been positive only 44% of the time between, 56% 6 months out, and 67% of the time a year out. Now, the LPL team points out that 9 cycles is a relatively short sample size, and they note a significant trend in more recent rate hiking cycles. They point out that the time span from the first hike to the first cut has more than doubled since 1985 as business cycles have lengthened. Bottom line, if the Fed cuts rates, there is a negative reason they believe they need to. Right now, consumer and balance sheets are in good shape as a whole. Inflation is firmly now in check, and we may miss a recession entirely. But things can change quickly, highlighting once again the reminder that stocks are long-term investments used to meet long-term financial goals. Getting in and out of the market on a short-term basis is a recipe for disaster. Thanks for watching. Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.